Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Kate Campbell, welcome to this episode of the Australian Finance Podcast.
Thank you, Owen. It's wonderful to be here.
It is indeed. It's always wonderful to be here. And today we're talking about using debt to invest. And we will be joined later in the show by our friend Cameron Gleeson at Betashares. This episode is a sponsored podcast by our friends at Betashares, long-term partners of the show. We're going to be talking about a few different things. And I want to insert a disclaimer up front, Kate. The disclaimer goes something like this. Obviously, everything that you hear on the show is general in nature. If you do need specific advice that is tailored to your personal needs, goals, or objectives, be sure to reach out to a licensed and trusted financial professional. You can find one on the moneysmart.gov.au website, or you can head to the link in your show notes, which says financial planning, and we'll match you with one. But I'm going to insert an extra disclaimer. The extra disclaimer goes something like this. When you invest in a way that uses debt, otherwise known as gearing or leverage, which we'll cover throughout this show, it can heighten the gains and the losses, and often in unintended ways if you're not careful. So go into any type of investing that you do with leverage with caution, exercise care, and know what you're investing in and why. This is where a good financial advisor can help, but also we will reference some ETFs throughout this podcast. So be sure to read the product disclosure statement and TMD that is available on the provider's website. That is it from me for the legal side of things. Kate, what are we talking about?
Yeah, so I thought we should start with why people might use debt to invest. And many of us are familiar with more common types of debt like credit cards. Maybe we've had a car loan. I know you've spoken about that before on the podcast. We might have a mortgage. But why would we use debt to invest? And why might it be something that could be positive? Because often in our minds, debt equals bad.
Yeah, it does. And we often hear then the phrase of good debt, bad debt. So obviously bad debts would be buying something that goes down in value or something that doesn't at least neutralize itself. So some people that own an investment property would say, yeah, even if the property doesn't go up, at least it's negatively geared, meaning that the rental income from the investment property covers the interest cost and it slowly pays itself down. There are many different types of bad debts. There's probably more of those on the consumer side of things. So when we're talking about credit cards, payday loans, afterpay, car loans, these types of things all depreciate in value, and they are typically very high in terms of their interest rate that they charge. Even some people who buy or get sucked into buying a car on one of those 0% finance or one of those things, oftentimes they're not really 0% finance. And even if they are, there's often a lot of strings attached and it's not what you think. So even if you get through that hurdle, you're still left with an asset that depreciates. So it's very rarely a good debt. But when we come to investing, there are many different flavors, and there are many ways that debt can be used to invest in something that creates more value than you otherwise would. And we're going to talk about ETFs with Cameron, for example. Those things effectively give you more exposure to a long-term investment. But people do use debt in a way to get an amplified position or a bigger exposure to something than they otherwise would, because you could invest $500 or you could invest in something that gives you more leverage and more scale and you get a bigger exposure.
Yeah. So my personal experience with debt is buying a property, because there is no way I had the money to front up for a property on my own. So I paid some of it, my deposit, and the bank paid the rest. So I took out a loan. So that's my experience with debt. But how can we think about using debt to invest when it comes to investing in shares and ETFs? What does that look like?
Yeah, so most of the time, people who have done this will be familiar with something called a line of credit. So basically, in effect, what you're doing is you're redrawing some of the equity that you have in a home or a property, and you're using that to invest in something else. But let's just take a backward step here and ask ourselves, well, why do people do that? Beyond just the reason that I mentioned before of getting a bigger portfolio or a bigger exposure, what people get is they get something called tax-deductible debt. And this basically comes about as a result of an investment that you make if it is for income-producing purposes. So buying shares would be a good example, or an investment property. That's the idea of negative gearing. So you make an investment and you're paying interest on the debt that you've made that investment with. But because you're going to pay tax on that income, it's effectively treated as something that's for investment purposes. And so because you pay tax on it, you can also claim the tax on your tax return. So it becomes tax deductible debt. Now, there are a lot of rules around that. And obviously, I'm not a tax agent, so go and speak to your accountant. And that's one of the big takeaways I hope everyone takes from this segment is go and speak to your accountant, because they will be able to tell you for sure if it is tax deductible and how to do it. And a part where people get confused is oftentimes they're used to seeing people buy investment properties and they've heard the phrase negative gearing. That just means that the rental doesn't cover the interest cost, so it's negative. But in the case of investing in shares, it's actually the same process. The difference is you're not getting another property with a loan attached to that property. You're using your existing property to get a loan to buy shares. And effectively, the property is used as security at the bank. And so the bank releases money and you use that money to invest. So imagine, let's use an example. For example, we'll just use very round figures. You've got $1 million property. And on that property, let's say, for example, you have a $600,000 loan. So if you're playing along, you would know it's $1 million minus $600,000 is your loan. So it means you're left with $400,000 of equity. Some banks will allow you to redraw up to 80%. So meaning $800,000. So we've left with $200,000 of difference there. So someone could withdraw that $200,000. It would be returned in a bank account. And then someone could put that in a brokerage account, invest it in ETFs or something like that, and invest that way. Many people prefer to do it that way because there's nothing like a margin call. So this is something you might hear Cameron talk about or anyone really talk about. But traditionally, when people invest in shares, what they would do is they'd go to their broker, so a CommSec, for example, and CommSec would be able to arrange a loan for them. That's called a margin loan. And they are quite dangerous, in my opinion. Not blaming CommSec, but it's just in general. Margin loans are quite dangerous. If you've seen the movie Margin Call, you would understand how high pressure these things could be. Basically, what happens is if you make an investment using that money, you have to have a minimum amount of money in the portfolio before they issue a call, meaning that they would say, hey, Kate, you need to put money in or we're going to sell the shares. And anyone listening to this will know that oftentimes the last possible time you want to sell is when it's fallen. You want to keep holding until it eventually grows, right? But with a margin call, you have no choice. You have to put money in or they're going to sell it at a bad time. So the difference with the property example that I mentioned earlier on is that because the property is the security, it doesn't matter so much what happens with the portfolio. The property is security. Does that make sense? Mm. Yeah. And so that's the way that most commonly people use debt to invest for the long term. I want to quickly clear something up. Chris Bates and I talked on the show about the difference between debt recycling and equity release. So in principle, they're exactly the same thing, but what you do with the money is philosophically very different. So debt recycling is using the same process of, that equity that you've got built up. You pull it out, you invest it, and then you get your property revalued. Whatever limit you can go up to, you pull it out and invest it. Then you go again, when the property goes up in price again or you pay more off the loan, you pull it out and you invest it. And you keep doing this process, and it's called debt recycling, because effectively what you're doing is you're taking money that you've got locked in your home and you're investing it so you get the tax deductibility of that loan. It's a bit, I don't like that. I think it's stressful. I don't think there's a lot of value added in that. But what I do think there is value added is using when you're young, when you're very stably employed and you have a high risk tolerance, there is definitely a place for these strategies, but they are not for everyone. They've been around for decades. So many people have blown themselves up. If you have a partner, you never do this strategy unless you talk with them first. That's my house rule. Don't ever do it until you've spoken to your partner, particularly if they're on the loan with you. They've got to be on board. Do not do it. It's not to say that's super risky. It's just because it is a big decision. A lot of people don't like to have a bigger loan, a home loan. and a lot of people don't like to use debt in general. So you've got to explain this process, and if you can't explain it to them, there's a chance you don't really understand it yourself. So don't do it. But it's a well-worn strategy. I wouldn't ever touch a margin loan with a 10-foot pole. I just wouldn't go there. It's too risky. Just like those CFD things, like they're all super risky, not worth it. What I'm talking about is long-term investing, equity release. That's it. That's my spiel.
That's your spiel.
Yes.
So what are some of the risks about using debt to invest in ETFs?
Yeah, so when we say, let's be really clear about when you say this, you mean in the share market generally. Mm-hmm. ETFs are one way that we, in our community, actively invest. You can use this strategy to do shares. The flexibility that comes with using the primary residence, so your home as security, is that you can go and invest in things that you want to invest in. In fact, it doesn't even have to be stocks or ETFs, Kate. It could be another property. That's really common. Another strategy is you could invest in a business. Obviously, that business would have to create income in order for you to be able to use the tax deductibility of it. So there's a lot you can do with it, right? But obviously, with great rights come great responsibility. And one of those is obvious. You're going to have a bigger loan. And that could be over 20 years. It could be over 30 years. If you're not a good investor, just stop. Don't ever do it. Like Warren Buffett, what was his famous quote? It was something along the lines of, people who are smart don't need debt, and people who aren't smart shouldn't think about it, or something along those lines. And the idea is like, so he said, yeah, people who are smart don't need it. People who aren't smart shouldn't think about it. So something along these lines. And basically what it is that you don't need this strategy. You definitely do not need this strategy. And while there may be benefits to it, there's a whole list of cons that come in the form of behavioral finance, things we can't quantify. So how you would feel if all of a sudden your $50,000 share portfolio was $250,000 and you're freaking out because the shares have just fallen 30% while also paying a bigger loan, because typically those things happen at the same time. And then what would happen if you lost your job? You've got a bigger loan. What would happen if you break up with someone? You've got a bigger loan. There's a lot of things that I have this belief in business and in finance generally is you don't want to do something that can kill you financially. You don't want to put yourself in a position where you can never come back from. And this is pushing you towards that line. So that's using that whole equity release, debt recycling strategy, investment properties. That's just like a domino effect. So it can even be far worse depending on where you go. So there are many reasons why you wouldn't do it. The final reason is if you struggle with the volatility, the ups and downs of the share market with effectively like a $50,000 or $200,000 portfolio or $1 million portfolio that's just your portfolio, imagine now you've got that 3 times. That's effectively what you're dealing with, that intense feeling and pressure. So it is not something for beginners. It is not something for people with low risk tolerance. You don't need to use any of these strategies that we're talking about.
Yeah. All right. Now, this is going to be a leading question, but if we don't have a property to release any equity from, we don't want to touch a margin loan or some other type of personal loan, how else can we use debt or leverage to invest? Yeah.
So we're about to hear from Cameron Gleeson from Betashares. And Cameron will introduce us to this idea of geared ETFs and leveraged ETFs. In particular, there's a new range of Betashares ETFs. They've been using these types of strategies for quite a long time, but these ones in particular have got a lot of chatter in our community. So we figured it'd be worth doing an episode, and Betashares figured it would be too. So we're going to hear from Cameron. I did cross to him. So if you are watching on YouTube, hello. And we will now hear from Cameron. For everyone on audio, don't worry, you'll get the full effect as well. Cameron, thank you for taking some time to join us on the show today. I really appreciate it, mate.
Thanks, Owen. Great to be here.
As always, we are talking about debt and we're talking about gearing and investing. And obviously, Betashares just launched a new suite of products, and it's caught the attention of a lot of our community. So can you tell us why the Betashares team decided to launch these geared strategies?
Yeah, and so as you just mentioned, we've just launched our Betashares Wealth builder range of funds, and we've launched 2 funds, the first of the 2 in that range. Going back a few years, we launched our first geared ETFs back in 2015, so a long time ago. We've got strong pedigree in terms of offering geared equity exposure to Australian investors. And the funds we launched back then were GGUS and GEAR, the ticker codes for those funds, which is basically diversified exposure to US equities and to Australian equities. Now, those are very popular funds and they've done very well for their investors. But what we tended to find was that a lot of, for example, financial advisors were using those funds for themselves, but not necessarily for their clients. And part of the reason for that is that those funds do have a relatively high level of gearing. So they have what's known as a loan to value ratio of between 50 and 65%. So that's a relatively high level of gearing. And we'll go into the details and the mechanics of gearing a bit later on. But what we found is that there's actually probably a gap in the market for funds that employ a lower level or a more moderate level of gearing. Because the issue with a more highly geared fund is that you perhaps have to spend a bit more time, have to basically put your hands on the wheel a bit more and watch that exposure, whereas a more moderate level of gearing really lends itself to a longer term strategy of building your wealth over the long term and taking advantage of the market's compounding power. So hence we've launched the first 2 funds in this range. So the fund ticker codes being G200, and that's our Betashares Wealth Builder Australia 200 geared complex ETF, and then our GHHF fund, which is really an all-world exposure as opposed to just Australia. So it's diversified exposure to Australian equities and global equities. And GHHF, and the name that fund is the Betashares Diversified All Growth Geared Complex ETF, which gives you that global and Australian exposure all in one package. So these funds are giving you those diversified tools to invest, but they're doing so with that moderate level of gearing. We think they're going to be really useful for particular investors. And in some senses, we're launching products here which are no longer just about the investment exposure. Like, it's very easy to get cheap exposure to broad diversified Australian equities exposures. But what these funds offer really is a solution to particular problems that certain client bases face. And that's where we think that the use cases are really interesting.
So when we say that gearing is involved, obviously it magnifies gains and losses. A lot of people are familiar with properties and those types of things. But how does the gearing actually take place? Like, how does it actually work?
Yeah, it's a great question. So maybe I'll just take a step back and just talk about the concept of gearing to invest in a general sense before talking about our funds. So imagine you're an investor that has, say, $2,000 of your own cash or capital to invest, and you decide that you want to employ some gearing. You may be able to borrow, say, an extra $1,000 to have a total of $3,000 to invest in, for example, the share market. Now, with that, investment structure, what you have, we would describe as a loan to value ratio of 33%. That's what an LVR, the acronym LVR stands for. Now, what that means is, in terms of your investment position, the returns on your original $2,000, the exposure you have to the share market is roughly 1.5 times the movements up or down on the share market. So if the market was to go up 10%, in the next day, your daily return on that investment would be 15%. If the market fell 10%, your return would be negative 15%. So that's sort of the mechanics of gearing, generally speaking. Now, the way that most people would look to gear within the share market might be to use, say, for example, a margin loan, and that's quite a cumbersome process. You have to complete a loan application, credit tests. There's a whole bunch of things you need to worry about, like margin calls. With the Wealth Builder funds, these are what are known as internally geared funds. So you don't need to go through any of that loan application process. When you buy, you can simply go onto the ASX and buy units in the fund, and the loan is internal to that fund. So the fund itself is borrowing the money rather than you as the investor. There's a lot of advantages to that. Obviously, those administrative burdens. It means you can invest a much smaller amount to access gearing. But there's also really key advantages in terms of getting a lower cost access to borrowing. Because one of the secrets to, if you like, gearing and investment is that you want to ensure that the return on your investment is higher than your overall cost base, including interest costs. So having a really cost-effective way of gearing stands you in better shape for outperforming, say, for example, an ungeared investment. So that's where we think these solutions really bring a lot of value to clients, and where they can be used as a long-term buy and hold if that's appropriate for your particular circumstances.
I love that you use the example of like a margin loan, which I know from seeing people use them or seeing them advertised that they're very expensive in terms of the interest rate that comes with them, as well as other forms of loans, and then that's applied to your portfolio as gearing. Can you give us a sense of the interest rate that applies to the wealth builder funds?
Of course. So for the wealth builder funds, these funds, as I mentioned, are internally geared. So it is the fund borrowing money rather than the individual. And that's really important, because when the fund's doing that, it's really harnessing Betashares, market power, if you like, as an institution to get access to really cheap cost of borrow. So when you're borrowing for a margin loan or, for example, an investment loan to buy a house, you're borrowing in your own name, and the bank's obviously concerned about your credit risk. We're operating in an entirely different market in terms of the rates that we can get. So the rates that we get are highly competitive in terms of the interest that's paid on the lending within the wealth builder funds. Because of that, we're actually subject to a confidentiality agreement. We can't actually disclose what those rates are. But needless to say that they're far lower than what you get on, say, for example, an investment loan, to buy shares, or dare say an investment loan to buy property. So that's really a key advantage that we see in terms of these funds.
And that's really interesting, and that's probably what people want to know, right? Because as you said, that's a key element in terms of like making sure the return over the long term exceeds the costs. And you kind of touched on the top of the segment there, where you mentioned why these funds have come out, even though Betashares has been doing geared products for a long time and has a pedigree. But why is it 30 to 40%?
Yeah, 30 to 40%. It's, I think, really the sweet spot for where we see a geared product that can, offer that sort of long-term investment solution. So I mentioned before that our original products in this space had an LVR, or level of gearing, of between 50 and 65%. So having that 30 to 40% LVR, what that translates to on a daily basis is that with that LVR range, if the market moves by plus or minus 1 or 2%, your participation in that daily movement is roughly between 140 and 165% of that move. Now, the really good thing about that's a relatively tight range in terms of your participation in movements up or down, but it also means that you're not increasing the volatility to a level that potentially is just unacceptable to a lot of investors. So you certainly do increase the volatility to the portfolio, but not to a degree where we think it's something which can't be used as for this sort of solution. Now, the way that the fund works is that it will maintain that gearing range around that level. So you've got a really good understanding as to how the fund will move on a daily basis, that relationship between the broad market and the fund's performance. I should note that if you look at longer term timeframes, there's going to be other impacts here, including the compounding the market over time. We can think about the fact that interest costs also are applied and will come out of the performance, the cost of the fund itself. We can think about the franking credits, the additional franking credits that you may generate, and if you are eligible to use those franking credits, that'll become a factor in your total return. So there's other factors at play, but on a very simple basis, very easy to understand how this fund will move relative to the market. And it's a relatively constrained range. It's pretty well known as to that relationship on a daily basis.
I think that's the key thing, is what you're augmented to is the daily basis, and how that the construction is built for not just daily trading, but just in terms of the understanding the mechanics. So I've got a couple more quick questions for you, if I may. And one of them is, when we actually had someone post in our community when the funds were announced, and basically said that they love the all growth ETF, like without the gearing, and they love A200. Was there a particular reason that these two ETFs were in effect chosen to be built on top of and then created the wealth builder fund, so to speak, if that makes sense? Like, why was it Australian shares and the diversified option?
Yeah, look, I mean, I think, the caller, your community members sort of hit the nail on the head in terms of funds that we think are really good solutions. And just thinking about the types of investors where, subject to their own circumstances, gearing might be, an appropriate, investment sort of strategy. So, we do see that, for example, young accumulators who are looking to build wealth might use something like DHHF or like A200. And one, I think, really good use cases for a moderately geared exposure to diversified portfolio is something like a dollar cost averaging approach. Now, I guess one point to make about those two, exposures, being that broad Australian equity exposure and the broad global exposure, is that, in terms of the free lunch in markets, is that diversification. That is the thing that reduces the volatility. So because we are employing a level of gearing, I think it's really important to maximize that diversification benefit so that, you are drawing down that level of volatility. I mean, just to give you a quick example, we looked at the most popular shares held by SMSFs in this country. It's in the Class Super Benchmarking Report. And we looked at a basket of the top 6 stocks, which are largely banks and miners. And we compared the volatility of that basket of stocks, say, for example, over COVID versus the G200 fund, the Australian moderately geared exposure. And they were, relatively comparable in terms of drawdowns and volatility. So, using that diversified approach when you are taking gearing as part of your investment strategy, we think is really important. And, clearly versus using a margin loan to buy individual stocks, there's a clear advantage from a risk perspective there. So that was why we started that spot. And we think that that's a really, useful space to start if you are going to look to use gearing in a portfolio, is that diversified approach.
Well, that was kind of going to be my next question, is how you see people using it. And actually, I didn't know that research around people like that being equivalent in terms of like the volatility that people would experience if they only held those 6 stocks versus something like this, which is diversified with the gearing laddered on top. So how do you see people using these funds?
Yeah, so and I should be clear on that last question. So if we think about what a level of gearing will do, if I think about that diversified exposure like A200 we mentioned, you would roughly say if the exposure you're getting through the geared solution is about 1.5 times, then you'd expect your volatility to be about 1.5 times that A200 exposure. The point being is that a lot of people don't have a diversified exposure. They have a very constrained basket of stocks, which do often have very high volatility. So, the way that we sort of see investors looking to use this portfolio, I think, generating wealth over the long term when you have limited capital, this is a really good tool for that. So say if, you're just starting out on the investment journey. Now, I should say with all these investment cases, two caveats there. You have to be comfortable with that fact that you can have a higher level of volatility with gearing, and you should have a starting assumption that markets will generally, doesn't have to be at every single point in time, but will generally appreciate over the long term. For a geared solution to be better than a non-geared solution. But, with those caveats sort of aside, the applications of the wealth builder funds, when you have limited capital, how do you start, accessing the compounding power of the market? Well, using that sort of dollar cost averaging approach, just putting in, say, $1,000 every month, if that's what you can afford to save, and doing that continuously, regardless as to the market cycle, means that, there'll be times when the market draws down. But ideally, if you're continuing to invest and the market then turns and starts to recover, you've also started to, you've been buying geared exposure when the market's cheap in that case, and you really get that sort of re-acceleration out of the drawdowns. And by continuing to invest, those drawdowns tend to be shorter in terms of your investable capital. So a DCA approach or dollar cost averaging approach using gearing when you're starting out, I think is really strong. And then we can sort of think about, say, for example, self-managed super funds. And we know that, look, super is a highly regulated sort of investment space. There are limits as to how much you can contribute. So from next year, your concessional contributions will be capped at $30,000 per annum. So, how do I grow my investment balance when I'm limited as to how much I can contribute up to that 30 grand cap? One way to do that is to use gearing. so you can actually access a greater degree of equity exposure and sort of build that wealth, build that exposure in your SMSF. Even later on, in terms of your SMSF journey, if you're lucky enough to be able to hit the SMSF caps, using a gearing solution can really, optimize your outcomes, including tax and liquidity inside and outside the SMSF. And then even later on in pension phase, we know that a lot of investors will look to allocate some money to, say, for example, a lifetime annuity, which is sort of akin to a term deposit with an annuity, sort of a lifetime guarantee. They'll look to use a product like that to maximize their pension payments. But that often means they have to draw money out of the equity market, so they're no longer participating in equity. So you can do things like combine that lifetime annuity with a geared solution like our Wealth Builder funds to maintain that equity exposure. Now, of course, all of these strategies are subject to, for example, in SMSF, you've got to consider the trust deed, what investments you're allowed to put into your SMSF and your personal circumstances. But you can just start to see how this geared solution can really play a role beyond just providing exposure, but sort of solving some of the challenges that different investor types face.
Yeah, no, it makes a lot of sense. And obviously, we would highly encourage anyone to get personalized financial advice and obviously read the product disclosure statements and TMDs that are available on the Betashares website. We'll put all the links in the show notes to that. And final question then, is there anything else like these funds are getting quite a bit of attention amongst our community? Is there anything else that you would say as we say goodbye to you today?
Yeah, look, I guess I'd say, I think these are like the two exposures we have, that diversified Australian exposure and just a single solution for your all equities or all growth exposure, which is diversified exposure, both Australian equities and global equities. It's a great place to start in this range. We'll continue to build out this range. Of course, for any investor that is looking to use these funds, they must be mindful of the gearing involved, and the fact that they will generally move on a daily basis by the exposure range. But, over the long term, things like compounding, things like, rebalances and the interest costs will slightly impact the overall outcomes. But, we're really pleased to be able to bring these to market, very low cost, both in terms of fee and interest cost. And we're just really hopeful that this opens up, an investment strategy, which is gearing, to a whole bunch of investors that previously couldn't access it because perhaps their investable balances were too small, or the complexity and costs of other gearing solutions were too great. And we're really looking forward to seeing how they go. And I'm sure Owen will talk about these funds again in the future. Yeah,
I'm sure we will, and continue to answer questions about them. So, mate, this has been really special. We do appreciate you dialing in and giving us your 2 cents on the Wealth Builder funds. And have a wonderful day. And thank you so much.
Thanks, Owen. Great to chat.
So that was Cameron Gleeson, Kate, from Betashares, who we love to chat to. I also did a recent webinar with us on the YouTube channel where he went through all those things in more detail. I will double click on something and remind everyone of Cameron's warning around these types of ETFs can increase the experience that you have, shall we say, with gains and losses. So be sure to read the PDS and TMD available on the Betashares website. And we've also included a bunch of resources in the show notes. If you do want to go a bit deeper, I would highly encourage you to check out the webinar that we did, because we did answer a lot of investors' questions on the fly in the community. And we also had Alex Luck, financial advisor, dial in for that one as well. So you can get a financial advisor's take. You don't have to just go and do all the research yourself. You can hear what financial advisors would do in that situation. So just to summarize this episode, Kate, we have a lot of topics that we've covered, and we've given them a little bit of coverage here. It is possible to use debt to buy shares, and the key benefit for most investors is you get a bigger portfolio, in effect. The second benefit is that what you invest, it may have an interest cost, which may be tax deductible. The number one thing when you do invest that way is to speak to your tax agent, because they can tell you for sure where the funds should be segregated. Maybe you need a separate brokerage account, and what things to keep to make sure that it is clean and able to be tax deductible. And then obviously we've talked about the ETFs, which is you don't need to go through the loan application. You don't need a primary residence. You don't need to get a margin loan to use those ETFs. You just purchase them the same old way.
Could these funds ever be in your core, or would they always be in a satellite?
I think you could probably have them either. I think for a lot of investors, they would be, in my opinion, they would be probably more satellite, at least to begin with, until people get familiar with them. These ones in particular have come out with slightly lower fees or meaningfully lower fees than the existing range that had higher fees. So that's a really big positive for people who do want access to lower cost ETFs in their core. And it's really important to understand that these are very well established, this style of ETF using gearing overseas. You can just search for US geared ETFs, and there are so many of them. So this is a really common thing, and I wouldn't be surprised to see more of Betashares issue more. I don't know anything, but I would assume that they'll probably do something like that because I imagine they'll be pretty popular.
It's always interesting to hear about the new products coming to the Australian market.
Yes, it is indeed. There was one question, and we received this probably 3 or 4 times on the webinar, which is about something called volatility decay. Now, I'm not going to go into deep theories and the maths of all this. Alex Luck, financial advisor from Everest Wealth, did send us a wonderful article on how that is explained and how it works. But basically, the short of it is that the return that you get from geared investments doesn't always equate to the perfect math of what you think is going to happen. Like say, for example, it's 1.5 times. Over 10 years, you'd think, well, it should be 1.5 times the return. No, not necessarily. So check out the resources. If you do want to dive deep, it is really important that you understand what you're invested in and why, as always. That's it, Kate. That's all we've got time for today.
Wonderful. Well, thank you for listening, everyone.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.